Hello and welcome to Leveling Up, Turning Singles into Doubles. My name is Brian Overby. I'm the Senior Options Strategist at Options Play. And we'll be looking today to talk about credit spreads and the general rules that are behind a credit spread. So I'm going to go through a very short PowerPoint that just talks a little bit about credit spreads, but we've done so many presentations on credit spreads, I don't want to dwell on it that much. And what this is the management of a portfolio. How, if I do a credit spread and I stick to the rules, what's my next step? What do I do when I made a profit? What do I do when I have a loss on the trade? And how can I manage that portfolio through and through? So, leveling up, turning singles into doubles, references credit spreads. And as I said, I'm Brian Overby, but I also, before we get too far along, also have to give you a disclaimer. We're going to be looking at real strategies today using real stocks inside a real platform that has real quotes. Not meant to be a solicitation to buy or offer any of the securities. Past performance is not a guarantee of future results. So we don't know who's out there. You need to make your own choices when you're coming up with your strategies in your stock. This is just meant to be educational. If you're going to trade options, this is from the first trade side of things, you must read the characteristics and risks of standardized options. It's all over the first trade platform. And if you need a hard copy, you can give them a call and they'll make sure to send one to you. All right, those are our disclaimers. I'm going to skip over the basic things. I'm going to get straight to the short-term vertical spreads. The two types of spreads that we're going to look at today that we're going to focus on are short put spreads and short call spreads. Inside the Options Play platform, it's referred to by the more technical term, a short vertical spread. And that basically means that you're going up and down on the quote board. If you were standing on the floors, the quotes are vertical. You're staying in the same expiration, but different strikes. So they can be established with puts or calls. If you do it with a put, you're bringing in a net credit, you're bullish. If you do it with a call, you're bearish. So you look at the profit and loss graphs here on both of these strategies, and that if you're doing a bull put spread, it'd be a substitute to, as opposed to buying stock outright. If you buy stock outright, you have unlimited upside and substantial downside. If you're looking at doing a bull put spread, a lot of times you're selling a strike that's just below where the stock is at. You hope that the stock either stays where it is at or drifts higher. The maximum you can make is the net credit received, but on the downside, you have a minimal loss, and that loss is created by the difference between the strikes minus the net credit received, but then you have a minimal loss on the upside. Bottom line is you have a high probability of success in that we are out of the money on the option that we're selling, so the stock either needs to just stay where it's at or go higher or drift higher, and you're going to do okay on the trade. So these are the standard, the outlook is neutral to bullish or bearish, depending on if you're using puts or calls. The net credit received up front is the maximum that you can make on the trade, but you have a high probability of success. So in general, you usually have more risk than reward whenever that situation happens. So if I just highlight these in a inside the slide in for the presentation, let's just zoom in on the bull put spread, and this will highlight what the maximum reward is. The max reward is limited to the net credit you receive. The max risk is going to be the difference between the strikes, this strike and this strike, minus that net credit received, and the break even is going to be this strike right here minus that net credit received, and that's where we cross the zero line or the x-axis. Want the stock to go up, and that's what you're looking to do. If the stock just stays where it's at, we're okay with that. Bear call spread. If I look at the bear call spread, we have the same scenario. It's as opposed to being short stock. Short stock, you have substantial upside as the market goes down. We have a net credit received, limited and known. If the market goes down, we're fine. The market stays where we're at, we're fine. But on the downside, difference between the strikes minus that net credit received, this strike plus the net credit received is our break even at expiration. Limited potential loss. Okay, so now we've done many presentations on short spreads and setting them up. So this is the next iteration. So if you want to go back and review some of them, First Trade does a great job of archiving all of the videos, and you would just want to look at vertical spreads or short spreads, something in the title, and it'll go into great detail on how the platform chooses the short spreads and some of the features of them. Okay, so now there's 3 rules, and this presentation I think really focuses more on the 3 rules. Right now we have a lot of earnings that are going on. A lot of the retailers are announcing earnings this week, and the big announcement today is NVIDIA, one of the biggest AI chip stocks, well, the biggest stock in the world, the biggest company in the world on a valuation basis. But with that said, this is more so for looking at strategies outside of earnings. And we're looking at a standard credit spread that we would normally do. If you go inside the First Trade platform and you're not focusing on an earnings trade, maybe you're just looking at the SPY, which is the ETF that tracks the S&P 500 index. Maybe you're just doing a simple trade to try where you're bullish or bearish and you're trying to capture some time premium. We had the volatility index up quite a bit today because of a lot of things that are going on in the marketplace. So you're seeing volatility is a little bit high. Credit spreads are an interesting trade during those time periods. You get more premium. VIX is trading right around 23 today, the volatility index. So when you're placing a 45-day short vertical spread, these are our simple rules. This isn't a speculative, well, it is, anything in options is speculative, but it's not a let's speculate on what's going to happen after earnings rules. Those are more fly by night. You're going to put them on and either you're going to make the net credit or you're not. And you might have a gap opening and not be able to get out, or a gap down on the open and not be able to get out, in both scenarios. But here are the general rules, okay? And here's the reason why we're going to do this rule. If the market goes up, you put the trade on, you have a high probability of success, like I mentioned. If the market stays where it's at, even if it drifts down a little bit, you can still make money on a short vertical spread if you set it up out of the money. The market goes in your direction, either up or down, based off of calls or puts, then the trade is simple. And in that instance, if the market is going with you, we're going to exit a 50% profit. But we're not going to stop there. We're going to exit and capture that gain. On the downside, we're going to exit with 100% of loss of the max gain, or 100% loss of the max credit received. So if I received $2 and that was the maximum I could make, the maximum I'm willing to lose on that trade would be, or the maximum I'm willing to pay to close it would be $4. Hence I put it on for 2 and I closed for 4. I lost 2. I lost the maximum that I could make on that trade. And if you start also, if you're starting with 45 days to expiration, we're going to look to close at day 21, no matter what. So if nothing happens and the trade is just blah, and either we're up a dime, down a dime, or whatever, as the days to expiration approaches, the standard rule inside the options play platform is that we're going to close it on day 21. Now you could say half the days. So if you start on day 30, you're going to close it on day 15. Your strategy didn't really work out for you. But this is the general rules. The platform highlights 45-day trades. And here's the reason, well, I guess I could go in a little bit of detail why we're looking at 45-day trades is time premium is your friend when you are incorrect on your forecast. So if you put on a short vertical spread or a call or put vertical spread, and the market goes against you and you have time value, the time value will make it harder to lose the maximum on the trade. So let me say that again slower. If the trade goes against you and you have time value, it will make it harder for you to lose the maximum on the trade. So on a short spread, you sell an option contract. And let's talk about puts. Let's talk about the bull side of things. So I'm going to sell near the money put option. And if the market goes up, well, that short put is happy. right? And then we're going to buy a further out of the money put option as protection. That put option is not happy, right? It is got time premium. You own it. It is hurting you, but your hopes are that the short option is helping you more. The market goes down, the exact opposite is true. The short option is all your risk, and that's what's hurting you, but the long option is helping you. Well, if that long option doesn't have any time premium in it, it can't help you out as much. But the idea is if the market goes against you, and kind of a general rule of thumb with me is if I'm doing a short spread, and I'm not even looking at these rules over here, if the market comes down and hits my long strike, that makes it an at the money option contract. And if you still have a lot of time remaining, well, you get some extra juice for being at the money. That's where all the time premium wants to sit. So if the market comes down on a short spread that I'm doing and it hits my long strike on my short put spread, then I'm probably going to get out, because if it keeps going on down, well, once again, I'm going to lose time premium. I'm going to lose that benefit of that trade. All right. Exit with a max profit of 50% of gain, with a max loss of 100% of the max gain, if starting with 45 days, close to 21 days. Now, here's the rule that we're going to talk about is leveling up, right? If we get to the 50% of profit, we're going to roll it or close and reopen, which is not a bad way to do it, honestly, as opposed to just doing it all in one trade. But you can, and I'm going to look through both of those scenarios inside the platform, okay? So with that said, I do see a couple of questions. Before I get into the options play platform, let's answer these questions. Okay. I haven't shared my screen yet. Oh, sadness. Okay, so here's the rules, and I'll leave it here with the rules. We have rule one, we're going to exit at a 50% profit of the max gain. So when I'm placing that 45-day short vertical spread, I'm going to exit with a 50% of profit. But what we're proposing that we're not going to do today is we're going to roll this position. If we get a 50% profit, we're going to level up and we're going to roll and we're going to turn a single into a double. That's basically the title of the presentation. I didn't come up with the presentation title, but this is what we're looking to do. Rule two, if we're out 100% max loss, well, then we get out. If we sold the spread for $2 and it's now trading for $4, we're going to get out. And then just a general rule. Now, once again, this is talking about 45-day vertical spreads. This is what the platform focuses on inside the options play platform. If we have a 45-day vertical spread, we're going to start with 45 days and we're going to close at 21 days to expiration. And that's basically our approach. It's the way that we're going to look at this. All right. So I can go back. I'll go through this. Let's start from the beginning here. And I'll run through this real quick. So let's do a take two, okay? All right. So today's presentation is called Leveling Up, Turning Singles into Doubles. My name is Brian Overby. I'm the Senior Options Strategist with Options Play. And I'll show you the disclaimer. Nothing's meant to be a recommendation today. I want to know that we're going to be looking at real securities, and it's past performance is not a guarantee of future results, and it's not a solicitation to buy or sell any of these securities. If you're going to trade options, you want to use the characteristics and risks of options. You want to review it. And this comes from the first trade side of things. We always have to make that available to you if you want to trade options. It's a great pamphlet that talks about the risks of trading. All right, so here's the short put spread. We're going to look at bull put spreads. We're going to look at bear call spreads. Here's the way we summarize them. If we do a bull put spread, we're bullish on the market and we're going to use puts, bring in a net credit. That net credit is going to be our maximum received. Our break-even point is the strike price minus that net credit, but we have limited loss because we're going to buy another option contract that's going to limit our downside. we look at the bear call spread, we have a net credit received. Once again, our break even is going to be the strike price, this strike right here, minus that net credit received. This is an alternative to being short stock. And then we buy another call option to protect us and limit our loss on the downside. All right. And so now we're going to focus on these rules, and I'm going to go into the platform, and I'm going to show how I'm going to show inside the platform a scenario. I'm going to paint a scenario of the fact that we put a position on, we made 50% of it, and how are we going to roll that scenario? So let me back out here one more time. And I pulled up the first trade platform, but I wasn't able to actually make the options play wizard work at this point in time. I might need to clear out my cache. So I'm just going to go into the platform that I use. This is just my standard options play platform. And Walmart's announcing earnings, and it makes it a little bit of an interesting trade. We have inside the research report in the earnings navigator section of this. In the earnings navigator section, we Walmart has an overvalued outlook heading into their earnings, and Walmart has always traded at a premium, and in past it's outperformed in that premium. So we're looking at like a PE of 38 times earnings. Now I bring that up because I did have a trade that was set up for Walmart that I wanted to kind of talk about. And that trade is profitable at this point in time. And that's part of the reason why I'm going to look at it. But if you look at the chart, we've had a lot of chop. We're hanging right around, we got the 20-day moving average crossing over the 50-day moving average. Here's the 200-day that has provided some support. And this shows a little bit of the stability that's in Walmart. There's only, right here, I would have been a little nervous on Walmart, but it didn't stay below the 200-day too long, and now it's back up. But we are seeing some chop in the marketplace, and we're heading into earnings. And Target announced the other day the consumers maybe getting a little bit weaker. Let's lean into the weakness. Okay. So the trade that had been put on Walmart was a short call vertical spread. So we were bearish, and we sold this option contract. And let's modify this. Went out 44 days. And this is the 101, 108. Let's make it simple. Let's go 106. And look at that trade. Okay, so in this profit and loss graph, and we'll pull that up, make it a little bit bigger. If this trade was on, the market's at 100.49. You have substantial downside if the market goes down, and this is an earnings report thing, but I'm going to adjust the trade. So I wanted to have something where we've recently had a downturn in the marketplace so that we could adjust the trade. And then you have your maximum risk here. So the maximum reward is the net credit received, $181. The maximum risk is the difference between the strikes minus that $181, or $319. And that's per 1x1, 101, 106 call in this instance. So inside this portfolio, I'm going to add it to the paper trading portfolio. It's trading at 108, and let's say we put this on for 180, and the market went down, and this was trading for 90 cents. So I'm going to create that scenario. This is what a normal trade would look like 45 days away. I'm going to adjust this, and I'm going to make this, and this is actually the trade that I had on and that I've already adjusted inside the daily play portfolio. But if we're at a 181 and this market now goes to a point where we're up about 50 cents on the trade, the adjustment would be that we go a little bit further out on the strikes and we're going to go down to about 30 days. So let's see where that would be trading at. Now realize we're painting a scenario where we might roll this position up and out in time. So we're going to modify this trade. We're going to make this be the 104. And we're going to go to the 109. 128. So we did the other trade and it was so we're right about there. Right about 50. What did we do it for 181? And let's, oh, I got to do the days to expiration. That's where we're at. And then let's make this a 30-day option contract. All right. Yeah, now we're down to $1. So we're not quite 50% on the trade. Mir Hussan, yeah, can you hedge an in-the-money leap call with spreads? Yes, you can. Yes, you can. Now everybody's seeing my screen, right? Please let me know inside the Q&A box. And I will talk about spreads here in just a second. Let's get this roll done. Okay, so 105, 110. Okay, so we're going to say we put this trade on for about 180. It's now trading for $1. What might we do to adjust this trade? And I'm going to send this to, I'm going to modify this. And we're going to send this to paper trades. So now I'm going to look at the portfolio. And we'll look at the Walmart position. If I click on this, it's saying there's 30 days left. So we started at 45, we're down to 30 days. Position is doing well. How do we roll the position? Not expecting that. Oh, I put the other trade in. All right, so let's modify this. Let's just close this one out, and then I'm going to adjust it. Okay, we've got our trade on. $30 days, 105, 110, 116, and a paper trade. So here's how the adjustment will work. So are at 30 days, I'm going to say we have a profit on that trade. Market has gone down. We're at 100. Our initial trade was the 105. We would look to roll down to somewhere close towards the 100 level. And we're going to go out further in time. We're going to go back to the 45 days to expiration. All right. And so we're at 105, 110. Now what we're going to sell is, I'd probably sell the 101, but I want to make this thing simple because I'm not making things simple at this moment. So we're going to sell we're going to buy the 105 and we're going to sell the 100. Just a little bit in the money at this moment. All right. So now if we look at this position, this is how you would roll up. If you're applying all the rules, if we're down double what we could have made on the trade, we did this for 180. If this is trading for 360, we get out. If we put the trade on and the trade goes nowhere, we get to day 21, we get out. If we are right on our forecast and the market goes up and we're making about 50% on our option contract, on our position, we put this on for 180, it's now trading for $1. We'd like it to be trading for 90 cents. But we're going to take that and we're going to apply the same filters and we're going to lean into the momentum to the downside, which Walmart is doing right now. So in this instance, we had the 105, 110 strike. We were short the 105 over here, short the 105. So we got to buy to close that. And we were long the 110, so we got to sell to close that. And then our roll would be, we're going to roll out to the 105 strike with a 44 days to expiration, and then buy the 110. Now, if we do this, we're going to bring in a net credit of $1.24 into the account. We'll be capturing the gain on the short spread, and we'll have an additional $1.25 that we could potentially make. And then we'd apply the same scenario. We're at 45 days. If it comes down to 21 days with nothing happening, we would just get out of the trade. If we make 50% of this, so this would be trading for 75 cents. That would be 150. So we're looking at $1.24. Once again, if we're doing this, we're looking at about 62 cents. And if we can get this done at the midpoint, if this goes down, if our new spread goes down to 62 cents, we would look to roll it again. And we would apply that same scenario. If we can make that profit, we'll go from a 30-day option out to a 45-day option and try to ride the momentum. Now, very rarely would I do this more than 3 times. Obviously, if you can get the market to continue within that, you're talking about a 45-day period, like 20 days periods. So 60 days in a row, you want to ride that momentum. That's a very solid trade. And your outlook can change, and it can be a different outlook if you'd like. But on the call side of things, this is how we're going to try to level up and how we're going to double up. And this is part of the reason why we're taking advantage of the fact that we're up 50% on the trade, is because we want to continue with the trade and see if we can make more on that position. It's okay if you let it expire worthless, but this is the whole setup that's involved with that trade. Now, I can go out and look at a different underlying if you'd like, but I do see a lot of other questions here that I'm happy to try to answer too. All right, everybody's seeing everything's doing fine. Do you want me to go through another scenario about the leveling up, doubling up? We did one on the call side. We could do one on the put side. And I wouldn't lean into the Walmart. I would look at a different underlying stock. I mean, we could look at it in Apple. Apple's announced earnings. And that might be a scenario on the call side of things where we would double up, and I'd have to paint that scenario. But I do want to answer the one question that I do see in here. How do I hedge an in-the-money leap with spreads? Leap call is losing faster than the spread is gaining. Uh, so in other words, it sounds like you do have that scenario where I bought a deep in the money call option as a surrogate for the stock, and the market is going down. Here's the problem is with the spreads, the issue with any spread, and I'll just look at this spread that we have in Walmart. So I think we still have it set up. Is that this is in this line here is the profit and loss as of today with 44 days remaining, right? So the line, the smooth line is as of today. The profit and loss at expiration is the hard line that goes all the way down, all the way up, and right here. So if you are buying spreads and you are doing longer term expirations, which I'm not quite sure if that's your scenario. If you're buying longer term options as a hedge, or I'm sorry, a longer term spread as a hedge against your leap, you need time decay to benefit you on that trade. For example, in this scenario, we have a short option contract on the call side of things that wants the market to go down, and we have a long option contract that wants the market to go up. In order for this spread to max out, the time value has to go away and expiration has to approach. So if you have a 60 or 90 or 120 day spread, it's going to be very hard for the option contracts to reward you if the market goes with you. It takes some time to do that. And that's demonstrated by looking at, even in our scenario here, we're talking about a 44-day option contract. And you see how big, if we get to the max on this short spread, right, there's a big difference right here between day 44 and day 0. And this would actually show me the P&L as of, it says November 19th, 2025, is $98.46. At expiration, it would be $245 at expiration. So that shows you the amount of difference. And if you're going out more than 44 days, that's exponential. So my answer would be, if I'm going to use a hedge and I'm going to be hedging short spreads against my longer term option contract, is I need a shorter time frame. I need to look at 15 days to 30 days and continuing to buy them. Now, here's the other issue with it, though, is that if you are buying a deep in the money leap call, why are you buying the protection? Because the leap call is already giving you protection relative to buying the stock. You're only paying maybe about the third of the price of the actual stock. Now, I might do it around an earnings report, or I might do it around something that might be concerning to you. But if I'm buying leap calls, I'm already protecting myself versus buying the stock outright because of the premium I'm paying. And my hedge would have a tendency to be to sell a short spread against it. One second, I need a little bit of water. Thank you. What would be to sell a call against your long option, like a covered call trade, or sell an out of the money short spread. I'm assuming that when you said I'm buying it as a hedge, you were buying a long spread, right? So let's go in and talk about that. All right. So I'm interested to know, I'm assuming that you went like you have a long spread, a lot of days to expiration on your spread position if it's not rewarding you as well as the leap call would. And You can look at the net delta of the spread to see how it will react relative to the stock. So if you have a leaps call option, and let's say you have a delta of 80, you can look at the delta of the long call and the delta of the short call, and you subtract them. And you see what that net delta is. Here's the delta on my long option. Here's my delta on my spread, the net delta. If the stock goes down, this is how much I would lose. And it will tell you, I'll give you a realistic expectation as to how much your spread will protect you in a downward movement on your long leaps call option. Okay, and I'm getting some yes. All right, so let's go and look at an Apple trade. And we had to restart here, so I'm going to go in and look at Apple. And inside the platform, we're showing a bullish outlook. Apple's trades at a high PE too, so that's a little scary too. But stock is up today, heading into NVIDIA's earnings. We're bullish, high implied volatility. Let's paint this scenario. All right, let's start with a trade. $44 days out, 280. Yeah, the platform it's a decent scenario. It's saying sell the 265, buy the 255s, and you're doing it for about $2.80. I think we're right at 270. Let's modify this and let's look at what a 270 would be. 270, 260, modify, trade. Oh, that probably would have been better if we would have did that. Okay, so 350. That's a viable trade. 44 days out, bringing in over a third of the width of the strikes. $3.57 on a 10-point wide strike. You're looking at about close to a four. You're over a third, and that's what's important. $3.57. So what we need to do to get to maximum, we need the market to move, and it's probably on a 44-day. Let's try moving at 5 points. Okay, so let's say that we had this trade on $3.50, and let's modify and say we were correct on our forecasts. And we're going to go down to a 30-day, and let's do 23, because that's usually where our adjustment might be. So 23 days is about half the time. And let's say the market went up 5 points, and that means that we would adjust our strikes. This would go down to 65, and this would go down to 55, implying that it's now 5 points out of the money. And if we trade that, 242 with 23 days. Yeah, that's not quite 50%. So it would have to go 10. Now that should be 50%. Yeah, 167. All right. So we put it on for 350. We're now at 167. We're close to 50%. Let's add this into the paper trade portfolio and say this was the scenario. We put this on with 45 days remaining. We sold the at the money put, bought 10 points out put option, a bull put spread, or a put credit spread, or a bull put vertical spread. Those are all the names that we did. Brought in $3.50. The market went up 10 points, and it took 20 days to do that. We're now earning about 50% of the net premium received. That's the picture. Let's trade this, send it to the paper trade portfolio, and we'll add that position. The benefit of first trade is you can actually just put the trade directly into your portfolio if you had the portfolio on, if you have that set up. And let's just look at paper trade. Okay, so in this scenario, I have the Walmart on, Apple on, and here's the position. Let's look at more details, and it's going to pull up over here, and we're going to roll this trade. So once again, you can just close these and then reopen them, which is fine if you don't want to put this all in as one trade. There's no problem with that. So it's just a little bit less confusing. You have a little bit of market risk, but if you're doing it all within the same day, and you're doing spreads, as we talked about just earlier on longer term spreads, they don't move a ton, but yeah, you do prevent any risk by doing all four legs. But here's the way the trade would go. So if we roll this position, we go from 23 days out. We'd want to go back out to 44 days. And our position would be the 260. We would roll back up to the 270. And buy the 260. And if we traded this, we're bringing in a net credit of $2 to the account. We put the trade on for $3.50, and we would have closed that trade, capture that gain, and go back and now have this trade on for a $2 net credit to the account. And this is trying to double up. You're riding the momentum. So we put this trade on when Apple, this is my scenario, put the trade on when Apple was at 260. The market went up 10 points, which isn't a huge amount in Apple. 3 points is 1%, right? So you're talking about a 3% move in Apple to the upside. When that move happened, we went back and adjusted our trade, took the profits on the short spread, about 50%, and then roll up to the initial trade that we had on, where we sold in at the money and bought 10 points out of the money and receive another net credit of $2. Now, why aren't we receiving the net credit of, what was our initial one, $3.60? Well, because we're buying to close. We're capturing the gain on the initial spread. And that profit of, in our instance, we were paying about $2. Well, we got about 50% of it. So $1.80 is our net profit on that position, and that's in the bank. We have that. We have a potential to make another $2 here in this scenario. And then if that happens and the market goes up again, then adjust this and roll it one more time. I don't very rarely roll more than 3 times, but this is one way to capture gains and move on to the next trade, turning doubles into singles. All right, any more questions? Well, that's going to be it for this episode. I don't see any more questions, and we'll be back again in 2 weeks' time. And if you have topics or so, let us know. We're willing to try to address some of them. Hedging spreads, hedging leaps with spreads is a tough scenario. I would be more apt to sell a call against my leap. That is my preferred hedge. But there's no golden book of answers. So that scenario can work, but you have to use shorter term options. All right, everyone. Well, I don't see any more questions. My name is Brian Overby, Senior Option Strategist at Options Play. If you'd like to follow me, please check out my handle on X. I'm at Brian Overby. And check out my book. It's called The Options Playbook. And we'll see you in 2 weeks' time. I think I'll be back doing the next presentation. I apologize for the snafu at the beginning. But we did a quick review, and you can obviously just start at that point in time where we did the first slide. All right. Thanks, everyone.